So you can be you can as a swing trader. Yeah, that's how I stop. You can trade the time frames 1 hour, 4 hour daily. You're looking to hold trades 2 days to 3 days, or maybe thereabout. But your trades don't have to last up to a week or so. Then the position traders are the people that stay in the market for a long time. One thing about swing trading is that it gives you opportunity. What you have to do is just make your analysis. Once you have made the analysis, you can spend the whole day doing some other activity you have. If you have a job, you can do the job that you have. You just put your price alerts at the areas, like when euro got to this area, this euro Aussie, I sold the pair. I sold it down to this area and I took profits when I saw this rejection. So you have to determine which um, time frames that you'll be trading as a swing trader. And you don't have to spend much time on your screen. When you come to your chart, you see what price has done, then you would react with what you're seeing. So um, while looking at that, then the position traders are the people that hold trades for weeks, for months. Most of the time, the banks are position traders. They hold the trades for a long period of time. So, especially when they believe that an economy is going to bounce back or an economy is going to do well over time. So, they hold the trades for a longer period of time. That's what position traders do. So, let us move down to the fundamental things you need to know. So as a forex trader, you have to know your technical analysis very well. So one of the basic lessons for technical analysis is candlestick patterns. So what are candlestick patterns? When you look at the chart I show you, you can look at all these things. What of if there is a way that you can read this price now? You can read this price and find out and read it and find out entries to make and how to trade. So it will, and when you can read what the price is doing, what the what the price is showing you, you can make entries. You can figure out the best places to buy and the best places to sell, the best places to take your profits. So when you look at that aspect, when you learn how to read the price action, the candlestick patterns, it will help you. So now we're going to take the candlesticks one at a time. So let us look at what the candlestick looks like. So I have some pictures I saved somewhere here. So this is a candlestick. So as you can see, there are two types of candlesticks. We have the bearish and the bullish. So for the bearish candlestick, we have what makes it bearish? It means that the price opened here. That the price opened here. People bought from here, and the price closed here. So it tells you that there is bullishness. There is a move to the upside. When there is a move to the upside, it's called it as bullish. So when it is bullish, it means that the opening of the price is lower than the close. That's the close is higher, is above the open. So if the close is above the open, that means it's a bullish candle. So from this candle now, you can see that the price opened here. When it opened, it probably went down, and this is the low, and this is the lower shadow. Some people call it weak. So if when the price got here, the buyers took the price up, it passed the open, and now the price went up and got this upper shadow. This is the highest price that this is the highest price that the pair got to before the bears, the people that sold it, or some of the people that bought that are taking profit. When they take profit, the price goes down. So when they are taking profit, the price closed just around this area. So that's why this is a bullish candle. So for the bearish candle, it means that the price opened high but closed lower. So that's, as you can see, the price opened high, then the buyers bought, but they stopped here. And during that same session, this candle can be a daily candle, a 1 hour candle, a 1 minute candle, a 4 hour candle, thereabout. So it is telling you what happened during that period. The price went up, but they could not keep it going. So the sellers sold it, and that's why it came back here. and they from the open they continue selling it to this point, and the buyers bought it and pushed it back to this place, and the candle closed here before another candle will form. So if it's a 1 minute or candle, after every minute another candle will open. Assuming that this formed during this particular minute, and in the next minutes, it means that this close for a bullish candle, the close will be the open of the next candle. So if this place is the close of this candle, the next candle that will open at this price that is here, and maybe form its own candle. So for the bearish one, the close is the open of the next candle. If it closes here, it means that the next candle will open at this place. Although sometimes in the market there used to be jumps when the price is in a high momentum, maybe something happened, like maybe a lockdown was issued in the UK. When the markets open, the price might jump. The price might jump from where it was lower or higher. So that's the only time the price will not open at the close of the other candle. That's one of the only time the price will not open at one of the close of the other candle. So that's for the um, that's for the candlestick. That's for the candle stick. That's the anatomy of the candlestick. So now we're going to look at the first candlestick here, the bearish engulfing bar. So what is the bearish engulfing bar? The bearish engulfing bar, let me get a picture here. Yes, this is the bearish engulfing bar. It's telling us that at this time, this bullish candle formed here. So the price opened here and closed here. But the next price that opened but closed lower, encompassing this smaller candle. It covered the smaller candle. Like it's bearish, so it covered the smaller candle. It's telling you that the bears have more power in the market and they are taking control of the market. So bearing that in mind that the bears now are in control of the market, it should tell you that okay, now there's a shift, a possible shift in momentum. So one thing that is good about learning the candlestick patterns is that it's going to help you to identify and read what is happening in the market. So the candlestick patterns are good, but you cannot trade them alone. I'll still come to that aspect. So after the bearish engulfing bar, we are looking at the bullish engulfing bar. So the bullish engulfing bar, we have something like this. We have something that, yeah, the bullish engulfing bar. We have something like this. So in the bullish engulfing bar, you see that there is a bearish candlestick, then we have a bullish. It's engulfing it. Is covering it, like it's preventing us from not seeing it. As you can see, it shows you that the momentum in the market has changed. That maybe the bears were there and they were trying to hold on to price. So with these two that we've talked about, we are going to look for them in the charts, because the only way that we would understand all these things is if we actually practice what we have seen. So let us look for the bullish engulfing bar. So the best places to look for a bearish engulfing bar is at the top of a trend. The bearish engulfing bar, you're going to look for it at the top of a trend. So why are we looking for it at the top of the trend? We are looking to see that at a particular price that the bears came and they sold, and now they have covered a bullish bar. So that's what you're looking for. Although most of the times you might not see this exactly. Why you have to know them is that they can appear at any time. So if you can read the price, the candlestick patterns on the charts, when they appear, you actually know what to do. So okay, now look at this place. Look at this place. As you can see, this bar, this is an example of a bearish, a bullish engulfing pattern. As you can see, this smaller red candle here, it showed that the price wanted to come down, but as you can see, this is a breakout. Actually, you see one top, two tops, three tops. This particular area has been tested once, two, three times. The more and more an area is tested, the weaker it becomes. So now when it tests the first time, many people will sell. Then now it's going to test the second time. Some other people will sell. The people that like to do the second selling, there are people that don't like to go through the first bound. So some people will say, okay, now it has come back. Let's sell again. They sold. So the thing still came back and tested again. What this is telling us that this place is going to get with. So from you might be looking for an entry and saying, okay, now it has broken. From this candle, you can see that you see that it has broken this resistance zone. So now we saw this bearish candle, and we saw that the bears wanted to take control and sell it back. But now the selling pressure was not there. And I found out that the next candle that formed was a bullish engulfing candle. And this is a bullish engulfing pattern at a very nice area of value. So if you bought, then if you have spotted this on time, you will actually buy on the next candle and put your stop loss just below here. So as you can see now, this particular candlestick pattern now, if you have been able to read it, you would have been able to take this trade. So that's why learning this candlestick pattern is very, very nice. It actually tells us that the things you have to do. But note that these candlestick patterns can appear in other areas of the chart where they mean nothing. So you cannot actually trade them as they are. You have to have other things, other confluences, other things that you look at to trade them. Okay, now if you are to trade this engulfing bar, you cannot trade it that is because of it's a bullish engulfing pattern. That's why you trade it. You look at the area where it formed. Where did it form? It formed at a resistance that has been broken, which has now turned to support. So with that now, you would say, all right, since it formed here, it is a high probability trade, knowing that this is a breakout. When you take your trade, you put your stop loss here, you found out that there was no drawdown. There was no minus on that trade. The trade was positive all through. So you hit your take profit at this level. So that is that for engulfing patterns. So let's move on to the next one. Save time. So we look at the doji candlestick. What is a doji candlestick? I'm going to tell you the anatomy of and how the doji candlestick is formed. It's very, very important that you just don't memorize the candlestick patterns. You know why they are formed. Okay. Okay. Uh, yeah, I did not get the picture for that here. Okay, let me show you the doji stick candle, what it looks like. The doji stick candle is an indecision candle. It forms when there is indecision in the market. That that's when the bears and the bulls, they don't know, nobody knows who would take control of the market. So let me look for a doji here and show you example of a very nice doji stick. So we look at this one. Look at this candlestick here. This is a very nice, is a doji candle. It's showing you that there is little movement between the open and close, as you can see. The doji does not mean that it has to be red or green. It's either bullish or bearish. It can be bullish or bearish. But the main purpose of that doji is to tell you that there is indecision. The bulls don't know whether they should. People don't know whether they should buy, or the sellers don't know whether they should sell. They bought and they sold, but they could not move. None of them could move the price. And further, you can see how small the bar is. You can see how small the body of this candle is. So you can see that the wicks are much, but the body is very small, very, very small. And look at this one. This one is also another doji candlestick. It does not mean that it has to form at the middle, but it's telling you that the open and close is very close. You see, there's almost no body for this candle. Whereas you can see all these candles, they have bodies, but not these ones. They have no body. There's doji candlesticks. So these doji candlesticks are shows of sign of indecision. But some in some cases, when this doji appears, it tells us that there is rejection. Like if you look at this doji here, this is a dragonfly doji. So this doji here now is telling us that the buyer, the seller sold this pair down, but when but the bears did not, the buyers did not allow them. They bought it and continued to buy it, and the buying pressure made this candle almost close at its opening price. So you see, this rejection now tells you that the buyers are also in the market, that they don't want the prices to go down. So with this kind of pattern now, with this kind of doji appearing at an area of support, if you look at, I'm going to talk about support and resistance soon. But so because of the appearance where it appeared, it's telling us that is rejection, that the price here that is being rejected. So it's actually tells us that we should look out that maybe this market is turning. So bearing that in mind, let us move to the next candlestick pattern. So we talked about the doji, the bullish, the doji, all of them mean the same. The dojis mean the same thing. So talk about the morning star and the evening star. So the morning star and the evening star. So when you look at the morning star here, so what does the morning star is? This morning star is a reversal candle, is a reversal pattern. So this, you're going to be looking for this kind of pattern in a downtrend, in a downtrending market. So when the market is selling and going down, and you see this kind of pattern in a support area, so you expect to enter your buy on the next candle after this one. It does not matter whether this one is bearish or bullish. In some cases, it will be bullish. In some cases, it might be bearish, but it does not matter. So what really matters is that you understand why the pattern is forming. So what it means is that the bears are in the market, and the market is in a downtrend. Then all of a sudden we are at a support level. So when we are at the support level, you notice that it's not the same amount of momentum that the sellers are using to sell the market, that they continually use to sell the market. And you see the smaller candles there. So this smaller candles is telling us that the momentum is decreasing, that the momentum that they're using to sell, that the sellers are getting weak. If there are nobody to sell something, then the people buying will buy. So it's more like supply and demand. It's when the market is in a downtrend, we are saying that the supply is too much. That when the supply is much, then the demand would not be, the price will be low. So since the supply is much, the price continues to fall, it continues to fall, and at a particular point in time, it becomes very cheap. So when there is no further supply of that currency pair, or maybe there is demand of that pair, you see the bullish candle, or the buyers now found out that this price is too cheap to buy at, and they bought. So when you see this kind of trend now, it tells you that the bearish momentum is getting weak. It's not telling that you should buy immediately, but it's telling that the bearish momentum is getting weak, that you should now start looking for a reversal. So that's one thing about the morning star. That's how the morning star works. So when you see something like this, you have to be able to read what is happening in the market. When you can be able to read what is happening in the market, it can help you to make decisions on what to trade and how to trade it. So we look at the evening star. So the evening star is the opposite of the morning star. Now the evening star appears at the top of a trend. It appears at the top of a trend. The evening star candlestick pattern, it appears at the top of a trend. So we have been buying and buying and buying. So we have been buying and buying and buying. So when the price got to this level, um, we notice that the bulls can no longer move forward. You can notice that you can see how small this candle now formed here, and the next one formed. It's telling us that the bulls, the people that are buying, are no longer in control of the market. So then once you see this kind of pattern, you know that a reversal is about to occur. So please, can you guys indicate if you understand? If you have any questions, please reply on the chat box. I want to see a response in the chat box so that I can know if I should continue or I should go back, or something I need to explain more. Please, can I see your replies in the chat box? Hello? Can I see your replies in the chat box? Okay. Okay. Okay, let's continue then. Um Now we're going to move to one of the very important aspects. So after that, we're going to talk about after the evening star. So let us look see if we can find some evening star patterns on our charts. So let's look at that evening star. Evening star chart patterns. So we basically, okay, we're basically looking for evening star chart patterns on and they at the top, at very close to resistance area, very close to areas of value. So look at this chart now. You can see this is an evening star pattern and it's close to this area of value. I will explain why it's an area of value very soon. So you can see that the bulls, the buyers are in control and they bought from this area of value and the price went up and came close to this area of value. You can see, if you can read the price action very well, you can see that when the buyers took control, they continued to buy, and you see that the sellers came and sold, and now you're seeing this second candle. This now is an indication that there is weakness, that the buyers can no longer continue pushing this market to the upside. So although sometimes this particular pattern can also not, it is whatever you learn in forex, none of them is 100% certain that they must occur that way. Sometimes they don't happen that way, but now you're going to look for what will work for you. It says that you see that 50, 100, 70% of the time to 80, 90% of the time that they are always work correctly. And also note that the more and more a support or resistance area is tested, the weaker it becomes. Some people will tell you that the more it's tested, the stronger it becomes. But from what I've seen in the market and from all the time I've spent on the market, the more and more it's tested, the more and more weaker it becomes. Why do I say that? Imagine this. What do you expect the market to do when it comes to an area of support or resistance? This is a resistance area. You expect the market to go down. You expect the supply to come in. So imagine when the market hits this place and they have supplied, and the people that are buying kept on buying, and it got to that close to that area again, and they still supplied. What does it tell you? That if they continue supplying and it keeps on coming back to this area, it has come back. This is the third time that it's coming back to this area, and they have come again to this area again. And look at how many times they have tested it. One, tested twice. Now I will not count this one. Then three, four times, and you find out that the price, when the price got here, it entered into some kind of range. So as a trader, you have to also be alert to see some certain things. When you're in the market and you see something like this, maybe you entered at the top here, maybe you put your pending order here and you entered and you sold. When you're there and you see that the price now is in a range, you have to actually get out of the market, or move your stop loss to entry to protect, because you do not know whenever there is a build up. I call this thing a build up at an close to an area of value, it actually leads to a breakout. So with that, let us not deviate much. There's a lot for us to talk about. So we have talked about the morning and evening standard. So let us talk about the pin bar. This pin bar, you can call it. There are two types of pin bar: the bullish pin bar and the bearish pin bar. The bullish pin bar, they used to call it. Some people call it the hammer. Okay, now I love the bullish pin bar and um, the bullish pin bar and the bearish pin bar because of how um, it helped me. There's a strategy I have that it works very well with. So let me show you what a bullish pin bar looks like. A bullish pin bar. So this is a pin bar, a hammer. That's the bullish pin bar right there. So it shows you that this is the market opening and close. It does not matter whether it's red or bull is green in color or red in color. What matters is that there is a small body and there is a long wick. It tells us that the price came all the way down to this place, but it was pushed back up. The moment the buyers were able to take it all the way up to this area and it closed there. So if you look at the candles, if you start understanding how these candles are formed, it will help you to make decisions in the market. So now that you know what this hammer is and why it forms, so when you see it on the chart, you not just say, okay, this is just a pin bar. You have to understand why is it forming? Why did this pin bar form? So I've explained to you that because um, the price came all the way down, but there was a rejection of that price. The buyers found out that this thing is extremely cheap, that the price was extremely cheap, and they continued buying it all the way up. So now and this thing is not just meaning that the buyers want to take control of the market. It also means that the bears can no longer force the prices down. They can no longer push the prices down. So with that in mind, now we go to the charts and you look for the pin bar, the hammer in particular. So let's talk about the two of them so that when we look at them, we'll make it easy. That's the hammer. So let's look for the so this is the shooting star. The shooting star is the bearish pin bar. It also has a long shadow just like its brother, but now it is on the opposite side. So we used to look for it at the end of a trend, showing us that the price was pushed down. That when the buyers wanted to sell it all the way up, the sellers pushed it all the way down. So, and if you see this kind of thing, it means that the buyers no longer have the strength, they don't have the momentum. Sometimes it's not just that they don't have the momentum again to continue. Sometimes it means that there is a rejection that are orders in that area. Like maybe some people have put their order, I want to buy maybe 50 euros, 100 euros, a billion euros when the price gets to this place. So when the price comes to where these orders are, because of how many how the magnanimity of those orders, it pushes the prices down. So with that now in mind, and you understand how these prices form, let's go and look for them on our charts and see how they work. So okay, now on this chart, I think there is one. So sometimes you would expect the market to show you these bars, but sometimes it don't show it exactly to you. When you look at this candlestick here. This candlestick is a pin bar, but you cannot see it as a pin bar. You can call it a tweezer. Okay. Let me not deviate things down is an advanced this thing. So now this is an example of a pin bar, and you can see there is this rejection. But now it's a rejection, but it's a false move. This rejection now is telling us that there is price rejection here. But you find out that after that price rejection, that the prices still went down lower. So it's actually telling us that it's not a must that when you see the bearish pin bar that um, prices will go all the bullish pin bar, the prices will go all the way up. This is the hammer. So it actually tells you that these patterns they can fail. So bearing that in mind, you cannot just trade them alone. You have to combine them with some other um, support and resistance. But if you look at, uh, I've looked at the winning ratio of all these patterns. I found out that this pin bar strategy, it does not usually, you can lose a trade, but in the long run, if you continue to execute it continuously, like a machine without emotions, that you make profits. Your account will be in the profit most of the time because you're actually fully what price is giving to you. You're actually following what price is showing you. So let us look for other pin bar. This particular pair, there's a pin bar on the weekly time frame. The weekly time frame. So you see, that is why it's good to most of the time look from the weekly. You see this pin bar. This pin bar now is telling us that there is price rejection. That is why we are seeing all the move to the downside. But now you see there is something about forex. The higher time frames cloud the lower time frames. The patterns on the higher time frames have more effect than the ones on the lower time frame. See this engulfing pattern here. You see how the price move. This this small candle here, this candle here now is a lot of pips on the lower time frame. It's a lot of pips on the lower time frame, but on the higher time frame it looks small. But on the lower time frame, this is a weekly candle. This is 5 days. This candle took 5 days, 5 working days to form. So on the weekly, it takes 5 working days for each of the candles to form. So, but now when you come down to the daily time frame, you find out that that weekly time frame will take 1, 2, 3, 4, 5 candles to form. So bearing that in mind now, it's going to help us to make decisions of how to trade the market. So one of the things about the pin buy is that it used to work better on higher time frames. When you use them on 4 hour time frame, they work, but not as well or as frequent as they work on the higher time frame. But I look at this now. You see this pin bar here. You see this pin bar here. It formed here, but it did not go down immediately. You saw another one. It formed. There's a pin bar. There is rejection again. So now the market respected that rejection, and it took 1 day, 2 day, 3 day, 4 days, 5 days, 6 days. See the lowest after 6 days. You see this lowest now. You see this area is an area of support. So it respected it, and another this hammer was formed. So the prices went back up. This rejection came and the prices went back up. You notice that as a trader, if you had taken this trade when you saw this pin bar at this area, you would have put your stop loss here. But this kind of trade now would have favored the swing traders, because as a daily trader or a scalper or intraday trader, you might not be able to hold your trade for this long. But you find out that the price tried all its best to break this level, but it could not break the level. You continue to see the rejection, you continue to see the rejection. So when you see this other rejection here, and with this one, the longer the wick, the longer the rejection, the better chances of the price is moving down. And so if these rejections happen on the higher time frame, on the daily time frame, they used to have more um magnanimity than when they happen on the lower time frame. When you look at this rejection, so you can see the hammer. This is the shooting star that formed here. So the shooting star that formed here. So all of them you can sell on the next candle. If you had sold here, put your stop loss above this shooting, above this place, you would have seen how many pips you would have taken. We can measure that. Measure that. Let's see how many pips you have taken. That's 131 pips. So something I did not share with you guys is how to calculate the pips. Yes, how to calculate the pips. So 131 pips, yeah, as maybe a scalper or a swing trader, is a good amount. Although some of the big boys, the people that would have been patient with that trade, you would have seen a total of 359 pips. This is the kind of trade I like to take. They have higher risk to reward ratio. So, but it's in what it all involves is patience. In the forex market, you have to be patient. So when you notice small candles coming into an area of value, it tells you that that area of value is likely to hold. It's very much likely to hold most of the time. So let me get that one off. So let us go to the things that we have. So we have the bullish Heramani. Heramani is in the Japanese, they look it at the mother and child. Mother and child. So When you're talking about the bullish ceremony, you're talking about the mother and child candlestick. So let me show you what it looks like. So we have the bearish ceremony. This is the bearish ceremony. You look for this particular candlestick pattern on at the end of an uptrend. What is telling me is that this particular bar formed, this bullish bar formed, then you start noticing this small candlestick. This is the mother and this is the child. This is the mother bar, the smaller body, this is the child. So when you see this one, most of the time when this kind of candlestick forms, the price does not go above these candlesticks. Most of the times, when it's a valid Hermani pattern, it's most of the time it does not go. What you will see is that the price will continue moving down lower. You see the first candle, second one, third one, all of them might be inside this candle, but and slowly they will break the lows of this candle. They will break the lows of this candle and continue to move to the downside. Then you have the bullish Haramani, the bullish mother and child candle. So the bullish mother and child candle is the opposite of the um, bearish. So what is why it's called bullish is that you see that the price will move to the upside. They move to the upside, you see that this big sell-off, a big sell-off, but there is no steam to continue the selling. Then you see that a smaller child is formed. So one of the things you notice how they are open and very close and how small this one is. So it tells us that a that maybe that the market is about to turn. It's a sign of weakness. That's why if you look at the charts here, if you look at the charts here, you find out that okay, you see something that looks like it. See this, this now looks is a bearish, is bullish Heraman. Why is bullish is telling when you say that something is bullish, that is indicating to you that the market wants to change direction. And if you had looked at it, it will tell you that yes, this is a bullish is a bearish is a bullish Sharamani, sorry. So it's telling that the market wants to turn. So look at how this mighty candle formed here. So you see this little one. It's telling us that the sellers could not push below it. So it's a sign of weakness. So from the area that it had formed, most traders would actually enter at the next day's open. So when they enter the next day open, they'll move their stop loss a buffer that's a bit lower from the lows of the candle. So if they had done that, or maybe they would have respected here and put their stop loss around this area and entered here and maybe done their risk to reward ratio and profitable trades and they executed the trade. So now that I've explained the various candlestick patterns that we have, I'll go down to the last one. The last one is the tweezers. The last one that we have today, the tweezers. Though there are two types of tweezers, they have the bullish tweezer and the bearish tweezer. So the bullish tweezer and the bearish tweezer, what makes them stand out? So let me look, see if I have one of their pictures here. Okay, it's not here. Um, let's look at the charts. Look at the bullish tweezer. Why is a tweezer is that most of the tweezers that exist, their candles are equal. The candles are usually equal. What it means that they have an equal matching force. So okay, this is another example of a bearish money. Why is bearish is that it's going to bring about a move to the downside. So one thing about tweezers is that they're usually of the same size, So being of the same size is when you see a tweezer at the top of a pattern. So let me show you a tweezer, although it did not form at the right place. This is an example of something that looks like a tweezer. It's a candlesticks that are almost equal, telling us that the price is like if this is an uptrend now and this market is an uptrend, it tells you that the bulls tried to take control, but the bears came back and sold back equal amounts. That the candles are of equal amount, telling us that the bulls are still in the bears are still in the market. Okay, now you can see that when someone sees this thing, you'll be thinking, okay, now this looks like a morning or evening star. Okay, yes, we are looking for an entry into this trade. But when you move further and you see now how this price now had formed this, it's telling us that the BS are no longer, they are not done. The selling is not over, that they are still in the market. They have matched this bar with this one, telling us that the momentum to the downside is still probable. So when you see that kind of thing, you know that the market will still continue lower. So since we have seen and we have been able to understand how to read the candle sticks, so please indicate in the chat box if you're with me. Indicate in the chat box if you're still with me. Indicate in the chat box if you're still with me. Let me know if I'll continue. Okay, I've been checking. Okay, indicate if you're still with me. Let's continue. The rest of you still with me. So we are going to move to the next thing. Any questions? Please indicate if you have any questions so that I would continue. Indicate if you have any questions. So now we're going to move to the next phase, support and resistance. Support and resistance. So for that, we would need to use a different chart. I want to explain support and resistance. EUR USD. This is that. EUR USD. I already have something on that one. EUR USD. Mm, okay. Let's use the British pound. I want to use something that will be easy to explain. Okay. Hmm. Oh, now we see the EUR USD. So, what is the support and resistance line? What makes uh, what? How do we know a support and resistance line? Okay, now support and resistance is a single line in the market. So now, how how do we determine support and resistance lines? So a support and resistance line will tell us the areas that the where the prices are being respected over time. Since we know that the prices will continue to repeat the same thing over time, we need to use the support and resistance area to determine and know what the prices will do again and again. So how do we pick a support and resistance line? I like to draw my support and resistance line from a higher time frame. Why? Why do I like drawing from a higher time frame? If you draw your support and resistance from a higher time frame, you would be able to know where the sellers or the buyers are. There are some people that place their orders at specific areas, and if you're trading the lower time frame and you don't take note of what is happening on the higher time frame, you will get caught. Maybe you find yourself buying at an area of resistance and selling at an area of support. So with that, I like to draw my support and resistance at a higher time frame. So what are the things? The higher the number of touches, the more reflected on the higher time frame it is. So we now draw the first line here. You draw the ones you can see before you start making adjustments. You see this one here. So take that one. See this one here. Take that one here. See this one here. See this level here. So so you have to take only the key levels. If not, when you start taking everything in the market, it will cause analysis paralysis. You will not be able to make decisions anymore because there are too much lines or so many lines in your chart. So if there are so many lines on your chart, it will cause analysis paralysis. You will not be able to make a decision. You cannot move. You cannot buy and you cannot sell because you're seeing obstacles everywhere. So that is why you have to make a line chart very simple, and you have to take and pick only the important areas on the chart. You have to pick only the important areas on the chart. So when you look at this chart now, the support and resistance areas are the areas that has been respected by price in the past. So what is a support area? A support area is an area where the price falls to. It's an area, it's a buying area. It's an area that is like a is like a ground floor. It's like a floor that stops the price from plunging deeper. Like it holds the price like a base. So when you're talking about support and resistance, when you're talking about the support, it's like a base, it's like a ceiling that is on the floor, like the floor, the base of a that is trying to prevent the prices from moving down lower, trying to prevent the prices from moving down lower. So um so now where are the places that we can see our support here? So this place is a support area. It's held the price from moving down lower from this area. And we found out that in the future, this happened in the past, in the future, the price respected that area. After breaking down here, it respected it. And this support turned resistance. Support will turn resistance once whenever support is broken, most of the time they turn to resistance. So the resistance area are the areas that stop the price from moving upper. It's like a ceiling that stops the price from moving higher. So when you look at this place now, you see that the price got here and came down. So now you hold on to this position. You know that this place has been respected by price before. So when you see that the price approaching here, there's a likelihood that the price will retrace, will come back down. But you find out that here it did not come back down. So we'll look into the dynamics of the times to look for a buy and the times to look for a sell and how to go about it. But now we talk about the support and resistance first. So you notice how this place now is a resistance point. So this is a resistance point. It's a resistance point. So this place is a support area. This support area in the future turn to a resistance point. You see how this place now is now respected. The more the number of touches, the more significant that area is. You see this one touch here, see two touch, see three touch, see four touch. We will not count these ones because of the way that the force break downwards. So we'll not count them. These are the important ones. The more the touches on this, the more important and the more reason we should be looking at it. So bearing that in mind now, we can move to a lower time frame. As I said, always draw for your support and resistance on a higher time frame so that it will tell you where the seller are. I like to design my own like this. I use the red lines to determine the higher time frame levels, support and resistance. Then when I come to my weekly or daily, on the weekly I use the same day red trend line, the red lines, because they tell me that yes, these areas are areas that have been obeyed before, but I should actually keep note of them. So now we move on to the weekly time frame. On the weekly time frame, we start to see other things. It's good to zoom out of your chart. Don't come and start looking for the candles when you're drawing support and resistance. You see them, you zoom out. You want to see the whole picture, a bigger picture. So when you now want to draw your support and resistance for the lower time frame, see this one here. You see, you see this level. You're trying to cover one touch, two touches, the other touch here. Then you see this touch here. So the price, this price did not get down here before coming down. So you say this area is very significant. So that's the only area we could spot on the weekly. Okay, see this area too. See this area too. So it's somewhere that has been obeyed before. So when you use this, you find out that you can count this one, count that touch, this one. You can adjust it a little bit. Okay, one, two, three, three touches, four touches. So it tells you that this area is an area to look forward to. It has been expected before, and as you can see, currently, as price approached it, price came back down. So a lot of things have been happening to the Euro USD lately. The elections and everything has made it look very, very not looking like something that is really, really interesting to trade. Although we've been expecting some moves to the downside that will allow or give us an entry, but still looking at it. So let us not deviate from where the class. So the daily time frame. So on the daily time frame, I like using a different color to show me my support and resistance levels. So different color. So, but from the look of things, we've covered most of the important levels. Although we might be looking at this level here from the daily time frame. Look at this level, this level here. See one touch here. See the second touch. You can count this touch, count this one, and this one here too. You now change the color. I like to change the color so that I'll be able to find out that yes, it's significant, but it's not really as significant as the reddish ones. The reddish ones are the ones that the banks are looking at. So when I have that in mind and when I design my charts like this, it will help to give me probable positions of and turning points in the market. So why it is good to look from a higher time frame to a lower time frame is that it will help you not to buy at a resistant level. Imagine when somebody bought here. Imagine when you bought at this price. What will happen to you? You lose a lot of money. But when you buy at low prices, it's a low price to buy from. All these low prices, or for somebody that even bought here, is a low price. So the idea is buying at a low price, and when the prices are high, you sell at a high price. You just focus on what works for you, find out what works for you. So bearing that in mind, we can now go to the 4 hour time frame. For me, I like using the 4 hour time frame to enter my trades and exit most of the time because I'm an intraday trader. I like to take my trades during the day and close it within the week. So we now move into the 4 hour time frame. And the 4 hour time frame, we see a whole lot of new things. So I don't like using, I like using a day shorter support and resistance on this one. Why this time frame 4 hour is kind of important is that for a intraday trader like me, I have to I have to buy and sell within the days and the weeks. This time frame is very very high probability for me. So we look at the prices and the areas that have been respected in the past. So look at this area, see one touch, see two touch, you can drag it all the way through. But you find out that at a point that all these places that it did not really hold. So it's telling us that the prices can come here, they can respect it. See what happened here. When the prices got here, it came down and it could not make another, it could not break the high, this high. It told us that there's weakness in the market. So for most traders, when they come and they are expecting the price to come and break back or test again. But when they see this kind of weakness that the price could not make it back, they sell from this area, put their stop loss a little above this high, believing that the price will not come back down. So for somebody that did that, imagine the amount of money that he would have made from selling that commodity, this pair. So bearing that in mind now, and we'll draw our support and resistance area. I like support and resistance, but what do I like? What I like more is supply and demand zone. So what makes supply and demand zone different from support and resistance is that I no longer view the support and resistance as areas. I think that's the last thing that we'll be treating. I don't like long lessons, so this one is now longer than it's supposed to be. So I don't like support. I don't like we are supply and demand zones now. I don't like um, treating support and resistance as a single line. I like treating them as zones. So how do I pick out my supply and demand zones? I look at places that prices have respected in the past. I like using the 4 hour time frame to determine my own supply and demand zone. You can find out what works for you. It might be a different time frame. But for me, I like using the 4 hour time frame, bearing in mind the area where the support and resistance is. So what I do is I look at those market turning points, especially where I will find candlestick rejections. So what I do is I come to take my rectangle and I draw my supply and demand zone. So where is the supply zone and where is the demand zone? This is a demand zone. A demand zone is basically an area where the price is found to be very cheap. It's an area where the price is found to be very cheap. So when people see when it's when like now the current situation that onions is very expensive. Some people bought onions when it was relatively cheap, even palm oil when it was relatively cheap. When you buy when it is relatively cheap, that is this area is like during that period, your a period of being relatively cheap. So in the forest market, we don't have seasons like that. We don't have seasons like in the real world. You have a season where palm oil is plenty or where this particular commodity is plenty. What we have is supply and demand zone, places where price has respected in the past. So if you can be able to plot your supply and demand zone, it will help you to find out probable turning points of the market. Now check out. Even if I had not seen this area form before this candlestick come here, but because of the respect, because of this area that is here now, I can come and draw it and anticipating price to come here in the future. So imagine if you had drawn this particular zone and now you see price here. And one good thing is that whenever you see price in your supply or demand area, what you'll be looking for rejection. See this rejection of price telling us that a lot of orders have been triggered, a lot of buying order have been triggered around this area, and it caused the price to move up. So as you can see now, the price moved up. So since you see this rejection here, it tells you that yes, that this area is a very good demand area. You can wait for the price to come back. Let me show you. Then you can go to maybe say 1 hour time frame. Let us see what happened in the 1 hour time frame. You can wait for the price to come back close to that area. You see, when the price got rejected, it tells us that yes, this area is an area of great importance and value. So it's an area, a good area to buy from. It's good to buy from an area of value because it gives you a higher risk to reward ratio. You risk little to gain a lot. So bearing that in mind, that's why I like supply and demand zone. Supply and demand is king in forex market. There are a lot of other things I'll teach you guys in future, but supply and demand is king in the forex market. I love using supply and demand zone because they are high probability for me. They have given me the best set of trades so far. So I don't like using harmonic patterns or memorizing patterns. I like behaving with what I'm seeing on the market. So now I look this is a this is a demand zone. So what is a supply zone? A supply zone is an expensive area where the market is found to be expensive. Now, from for me, this is an area I'll see as expensive. So there's something about forex. You know, we all know we want to make money. We want to make money. But forex is involves a lot of patience and discipline. You cannot make money every day in the forex market, but you have to be patient for the opportunities to make money to come to you. When those opportunities come to you, you then utilize them. So you have to be patient and wait for price to come to the areas you want to trade them, or you want to see them visit before you can trade them. You cannot come to the market and chase the trades. So you cannot come to the market and chase the trades. So with that in mind now, you can plot your supply and demand zone. To me, I'm looking for the price, this price now to get to this area. This area is an area I'm looking for a sell. I'll look for to sell it down to this area because I believe that this area will become an important area in the future because you see how price has respected it over time. See how price has respected this area over time. But for the fact that from the way this one is moving right, I think it's going to break. I think it's going to continue to move higher. All these moves in the market is because of um, bidding one, bidding winning the election. So with bidding winning the election, most of the pairs moved very well against the dollar. So with that, um, all these areas are supply zones. I have something on supply zone I did on gold. So on gold, so these are areas I'm looking at on gold. So on gold, this is a very strong area, and gold has been in an uptrend for many years now. Many years now, gold has been on the rise. You can see how it rose, got up to this level, came back down, and it's still moving. So some analysts believe that it's going to continue moving further. So go back to our 4-hour time frame. So I'm trying to explain to you and show you how I draw my supply and demand zones. So when gold when gold came down to around this area, so we you know 2 hour chart. It came down around this area because of what happened. It made this area an area of supply and demand, of an area of demand. But when it came back, price did not get down to this area before reversing. So it also turned this area to as a potential area of demand, supply, sorry, demand, sorry, area of demand. So as you can see how price came back to this place and came back down, broke it, tested it. You can see how it came back and tested it. Move up, came down. See how this place held again. There was demand again, and it rose up, entered this trend line, then broke this trend line, came back down, then broke it. So we are all looking for price to get to this area, so it did not get there. So we allowed it to go. Although with bidding winning the election, the price of gold has gone up. But I think this is a false move. I expect the price to at least come back down to this area. So now I'm going to look at this area next to. So I'm looking at this area because one, this 1906.48 is a very strong area. When you look when we move to the weekly or the monthly time frame, you look at this area, you see this is the highs of this market before. This happened in 2011. So it tells us that that area is an area of great importance. So for price to have broken it now recently, it means that it's likely that it's not one thing I don't advise people is don't buy at high when the price is very high like this. You might maybe say yes, maybe the price will go up higher, but it's not advisable to buy. Where will you put your stop loss? Where would you want to put your stop loss now? There is no particular logical place. Will you put it here? All these places, there is no market structure to support, to hold it. It's just like somebody when you're inside a room and someone locks you in and you want to escape. When you want to escape, when you come, like look at this area now. Is the price is here, price got to this place. Is this place is like a ceiling that the price is trying to break. When the price came and got to that ceiling, it could not break it. It came back down. Then when it came back with a greater force. You look at how this big candle almost covered everything. So it came back with a greater force and broke it. So you see, is that kind of principle is the same kind of principle you can apply in trading. So now you have to buy close to a floor, a base, or close to or and sell close to a ceiling. So the ceiling, most of the time when a ceiling is in, like when you're looking at the ceiling, when it is tested for the first time, it usually respects. You might see this breakout now. It broke out the first time. It broke out the first time and retested. Then it came back to test the second time. You see, this second time now, since it's not a supporter this time, it's the first time it's testing it. This place is a resistance point. Or when it broke it, it tested it and made it a support area. So now it's the first time that the support area now has been created. So most of the time, the first touch usually reverses immediately. Most of the time, it usually reverses. So when you see that reversal, it's a good area to buy. You buy. When you buy here, you put your stop loss here, and you according to your risk management. If you're taking 1:2 risk to reward ratio, okay, let me show you what I mean. One is to how to find out your risk to reward ratio. So you can do that by yourself. You can do that by yourself by simple calculation. I will talk about that in another class. So I want to just show you an example of what I mean by good risk to reward. So when you're in the forex market, going long means buying, going short means selling. So when you're long, let's say you saw this support and resistance and you put a pending order. That's if you're somebody that don't have much time to look at the chart, you'll be using pending order most of the time. When you put your pending order down at that entry, so you don't expect price to move so much. So what you do is you put your stop loss a little bit above that area that you believe that is going to hold. Then when you put it there, um, you put your entry just a little below. So you find out that if you are taking these trades, that you would have gotten that's almost 400 and that's almost 4,000 pips. This 4,000 pips, that's a lot of money. That's almost 40 something dollars if you're using a 0.01 lot size. $469 if you're using a 1.0 lot size. So one thing is that gold is quite risky to trade. And you look at the risk to reward, 10.97 risk to reward ratio. That means, okay, you can say bring this thing down. That means you're risking so little for a very large amount. That's how forex works. You risk a little for a large amount. So in forex, you have to be open. It's not a get rich quick scheme. You have to be open and believe that at some times you can be wrong. But now it's not about how many times you're right or wrong, but the times that you're right, you're going to catch a lot of pips in the market. But the times you're wrong, you're going to catch little. Don't think about the money you make in forex first. If you think about the money you make in forex first, you might end up not making anything. You end up just losing your money. So don't think about the money, think about the process, how you move on your trades, what are your watch lists. So I advise each and every one of you to get a book. Inside that book, you would write out your trading strategy. What is the trading strategy? Will you be buying supports and resistance? Will you be trading pin bar? What is your entries about? You record your trades every day. Any trade you take, you record them. Any trade you take, you record them. What will this do for you? Many traders neglect this, and I neglected it when I started. So with time, you'll not be able. There are days that the market will not go in your favor, and you start asking yourself questions. But if you have a record, days that the markets are not going in your favor, you can view those records and find out what you did wrong, what you can do right, and how you can make your trading better. So, but if you don't have any record, nothing to go back to, nothing to backtest your strategy, because before you put your strategy in your real life account, you have to test it in your demo account. So if there is no way that you can test or backtest your strategy, there is no way you can find out if it is profitable or not. So for any strategy that you're going to test, make sure that you consider your risk to reward ratio. The risk to reward ratio in the sense that imagine if you are taking this trade and you got 5 times of what you're risking, and you are patient enough for this trade to hit this take profit. So when this trade hits this take profit, what it means for you is that now that the trade has hit take profit, you would earn a lot of money. Then if the trade had hit stop loss, you would have lost a little amount compared to what you would have made. So the idea is you don't have to be right all the time, but the times that you're right, they have to matter. One win alone can cover 10 losses, can cover 5 losses from what this trade is showing us 5.27 risk to reward ratio. This is very mighty. This is a very good risk to reward ratio. Sometimes why I don't like scalping or taking small profits is, imagine if you take a trade and you make $2 or 5 cents or 50 cents or small this thing. When you make those small amounts on a day that you have a big loss, maybe as a scalper now, you're watching the market, all of a sudden you are caught unawares, maybe you did not check the news updates, and maybe you bought something, and as immediately you bought it, they got that news from that country that something bad had gone wrong. All of a sudden the market start moving against you, and maybe you did not put a stop loss, which many people don't do. They don't put stop loss believing that the market will move in your favor. Stop loss is one of the safest things that will save you a life in the forex market. You always have to determine what you are willing to risk, and you have to be open. So one of the things that affects forex trader is that sometimes you don't believe that you'll be wrong in the market. You think that every time that you trade that you have to win. You don't have to have that mindset. If you have the mindset that every time you trade that you have to win, when you eventually lose, it will affect the way you think. And when it affects the way you think, you start hesitating. You see opportunities in the market, you cannot take them because you're not afraid that you might lose. That is not how you're supposed to think as a trader. So I believe that I've done justice to what our topics today. I think other ones now, we can talk about them in other classes. Please indicate in the chat box if you followed the lesson. Please indicate. I will mute the mics now, and I want to hear what you guys have to say. I'll call it a day. Hello?
The lecture was good.
Okay.
The supply was and the demand was very interesting.
Okay.
Yeah.
Okay. So any questions? If there's any question or anything you want me to do or look at, I would be happy to do that. What is that? Is there any question?
Now there's none for now.
Mr. Chenji, are you with us? Hello.
Hello, someone.
Yeah, I want to know if Chimdia is with us.
Okay.
So on Sunday, I would like us to go through the pairs that I'll be looking at for the new trading week. So there are some pairs that I have on my watch list, but we'll discuss them more on Sunday. So if you have any suggestion of maybe something you want us to talk about on Sunday before we look at the pairs, you can drop them, you can send them to me. I will look at them and maybe create a topic about them so that on Sunday we'll treat the topics first before we go into the pairs I have for the week. Then we can you can give me the pairs you want us to look at, we'll forecast on them and determine the trading opportunities that we can find there. So
All right.
don't know if Chinga is still with us. I think the class is over now. Um,
Okay.
I
Oh,
hope
thanks for the lecture.
you see
Thank you for the lecture. It was
very
interesting.
very much welcome. Okay, now
Yeah.
that will be all until we see you next time.
Okay.
All right.
Thank
Have a
you. Good
wonderful,
night.
yeah, have a wonderful day. Mm.
Yeah. You too.